Hello class, and welcome to the video lecture for partnerships. The third learning unit covers the journal entries to record the admittance and withdrawals of partners. The admission of a partner means a new partner is joining the partnership. There's two ways for an individual to join a partnership. One is to purchase the equity interest from current partners. This means a purchase of a current partner's owner's capital. The other way to join a partnership is to make an investment. When a new partner is admitted, the old partnership, as a business entity, is dissolved, which means it ends. A new partnership entity is reformed to include the new partner. Let's look at the textbook example on page 629. On April 3rd, Ryan sold Mix his equity in the company for $9,000. Let's analyze this transaction before we journalize it. Ryan is the seller and Mix is the buyer. Mix is paying Ryan $9,000 in cash. Mix is not paying the partnership as a business entity. Mix is paying Ryan, the individual. Our task is to journalize the entry into the partnership accounting records. In the partnership accounting records, Ryan's capital balance is $6,000. We see that here on the right side of the statement of owner's equity for the partnership. So Mix is purchasing Ryan's capital balance, which is $6,000, for $9,000 cash. To journalize this transaction, we debit Ryan's capital account for $6,000. This zeroes out Ryan's capital account because he sold it and is no longer a part of the partnership. We admit the new partner, Mix, by crediting Mix capital for $6,000. The fact that Mix paid Ryan $9,000 in cash for his capital account has no effect on the partnership. Mix could have given Ryan 100 pencils in exchange for his capital account, and the journal entry would be the same. Now let's look at the next example, investing in an existing partnership. The example says Roger Foss wants to invest cash in a business so that he will own a 1/3 equity interest in that business. So what must be the value of the assets he invests in order to obtain 1/3 interest? To determine this, we must look at the current equity of the partnership. The partnership currently has two partners, Blee and Jarvis, and the total equity is $4,000. Think of this in terms of parts, with each partner being a part. Currently, the partnership has two parts, and two parts is valued at $4,000. That means one part is $2,000. If Roger joins the partnership will then have three parts. If Roger wants a 1/3 interest, he wants one of those three parts. And how much did we determine was one part? It was $2,000. Now that we've determined the amount, we can journalize the transaction. So the partnership debits cash for $2,000 and credits Foss capital for $2,000. Now let's look at an example involving a bonus. Bonus is the term used when a partner pays more or less to the partnership than the accounting value of the equity. The rules are, if a new partner pays more, the old partners share in the bonus. If the new partner pays less, the new partner receives the bonus. Let's look at an example. We have Blee and Jarvis again for total equity of $4,000. Now we have Foss who wants a 1/3 interest. But the partners Blee and Jarvis won't allow Foss to join for $2,000. They require Foss to pay $3,500. So our goal is to journalize the transaction, so we need to determine what we credit to each capital account. Foss pays $3,500, which is a debit to cash. But how much is credited to his capital? He wanted a 1/3 interest. So if, after Foss's investment, the total equity of the partnership increases from $4,000 to $7,500, 1/3 interest would be $7,500 divided by 3, which is $2,500. So we credit Foss Capital for $2,500. The bonus is $1,000 because Foss paid $1,000 more than the accounting value of the equity. This bonus is split evenly between Blee and Jarvis by increasing their capital accounts $500 each. Now let's look at a bonus to a new partner. This can occur if current partners agree to admit a new partner for an investment less than the accounting value of the equity. In this example, Blee and Jarvis want Foss to join their partnership so badly they offer him a 1/3 equity interest for only $1,400. We determine the credit to Foss's capital account the same way. If Foss's $1,400 investment will increase the partnership equity from $4,000 to $5,400, what's 1/3 of that? 1/3 of $5,400 is $1,800. So we credit Foss capital for $1,800. In this case, Foss's capital is $400 more than what he invested, which is his bonus. The bonus is taken equally from Blee and Jarvis, reducing their capital accounts with a debit of $200 each. The final example is journalizing the transaction when a partner withdraws from a partnership. 3 steps are involved. The first is to adjust all assets to their current fair market value. We'll see an example of this in the next slide. The next step is to allocate any difference between the fair market value and the accounting records value, also called the book value, to all the partners. And then the final step is to record the withdrawal. Let's look at the balance sheet of the partnership from the example in the textbook on page 631. We have assets such as cash, merchandise inventory, and store equipment. At the time the partner is withdrawing, we need to evaluate each asset and compare its book value to its fair market value. The value of cash on the books is the same as the fair market value of cash, so cash is never adjusted. Inventory, however, may actually be worth less, meaning it has a lower fair market value than what is recorded on the books. This could be due to a decline in its value by customers. This particular example says inventory is overvalued by $400, which means the amount recorded on the books is too high by $400. The example doesn't say anything about store equipment, so we can assume its book value is equal to its fair market value. So we have $400 in overvalued inventory. We reduce the merchandise inventory account by crediting $400. We debit each partner's capital account according to how the partnership agreement says losses are to be treated. In the example, it says on page 631, Ring, Rotter, and Freeze have a profit and loss ratio of 1/2, 1/4, and 1/4 respectively. This means Ring gets 1/2 of the $400 reduction in inventory, and Rotter and Freeze get 1/4 each. So this works out to 200, 100, and 100, which is recorded with a debit to each partner's account. Now that we've evaluated the assets and adjusted accordingly, the last step is to record the withdrawal of Freeze. After the last entry, Freeze's capital account was reduced from $2,000 to $1,900. We reduce Freeze's account to 0 with a debit to his capital account of $1,900 and then record a credit to cash of $1,900. In the last example, Freeze took $1,900 cash, which was the same as the value of his ending capital. Now let's look at a situation where the withdrawing partner takes assets less than book value. In this example, on page 632, we have Joel, Smoot, and Jangles. Smoot is withdrawing from the partnership. His capital account balance, as you can see here on the balance sheet, is $18,000. He accepts cash of $12,000 to leave the partnership. To make his capital account balance zero, we have to debit it for $18,000. Then we credit cash for $12,000 because he's being given cash to leave the partnership. The difference is split between Joel and Jangles according to how their partnership agreement specifies they share profits and losses. The profit and loss ratio before Smoot leaves the partnership is 2 to 2 to 1. I'm getting this out of the textbook. But after Smoot leaves, it's just Joel and Jangles, so the ratio is now 2 to 1. That means there's 3 parts, and Joel gets 2 out of the 3, and Jangle gets 1 out of the 3. If we divide $6,000 into 3 parts, that's $2,000 per part. If Joel gets 2 parts, and 1 part is $2,000, then Joel gets $4,000. Jangles gets 1 part, so that's $2,000. In this final example, the partnership has decided not to adjust assets to their fair market value. It's found that the assets are undervalued by $12,000, but instead of crediting the asset account, the remaining partners accept a reduction in their capital accounts. Smoot's share of the $12,000 undervaluation is 2/5 of $12,000. That's his part in the profit and loss ratio. 2/5 of $12,000 is $4,800. So Smoot receives this as additional cash to retire from the partnership, and the $4,800 is allocated to Joel and Jangles according to the new profit and loss ratio after Smoot leaves, which is 2 to 1. I know that the example we just did was difficult. You do have homework problems that ask you to journalize the withdrawal of a partner, but I'm not going to ask you to do it on the quiz or an exam. Instead, please focus on the journal entries related to the admission of a partner and the formation of a partnership as we discussed in Learning Unit 1. Let's do problem 17B-2 on page 649. It says Bob North and Whitney Ahern are partners with capital balances of $1,300 and $800 respectively. They share all profits and losses equally. From the following independent situations, journalize the admission of the new partner, Jack Underwood. Okay, situation 1. Underwood purchased Ahern's interest for $6,400, paying it personally to Ahern. So ask yourself, who's paying whom? Underwood is paying Ahern directly, not the partnership as a business entity. That means you ignore the exchange of cash in recording the transaction in the partnership accounting records. So, situation 1. We simply close out Ahern's capital account by debiting Ahern capital for the value of his capital account, which is $800, and we set up Underwood's capital account. So this is when one person pays another person, not when they're paying the partnership. Okay, situation 2. Underwood invested an amount exactly equal to 1/3 interest in the partnership. So this means he invested the accounting value of 1/3 interest. So let's divide the partnership up into parts. It currently has two parts. We've got Bob, let's see, what was this? Bob North. And Bob's capital account is $1,300. Okay, and then we have Whitney Ahern. So sorry, my pen is not behaving here. Whitney, 800. Okay, so the total capital right now is $2,100. So this is the value of two parts because we have two partners. So what's the value of one part? One part is 2,100 divided by 2, which is 1,050. Okay, so that's what Underwood needs to invest in order to have a 1/3 interest. And we journalize it like this with a debit to cash of 1,050 and a credit to capital Underwood 1,050. Okay, so now let's check just to make sure he has a 1/3 interest now that there's three partners instead of two. So now we have three parts, and the total capital is this 2,100 plus what we just added, 1,050, which equals 3,150. Okay. So what's 1/3 of 3,150? If we divide that by 3, well, if you plug that in your calculator, you get 1,050. So that's the balance in Underwood's capital account, and so we know we have calculated it correctly. Okay, let's move on to situation 3. Underwood invested $4,200 for a 1/3 interest. North and Ahern share the bonus. Now, how would you know that there's a bonus if the textbook didn't tell you? You would, because you just calculated the accounting value in the last example, which was 1,050. So now Underwood is going to pay $4,200 for that accounting value of that equity of 1,050. And we call that difference a bonus. Okay, so let's look at the calculations. First, let's add up the current capital accounts of North and Ahern again. I just erased it, but it's what we had before, 1,300 plus 800, 2,100. Okay, that's the total capital. Now let's add in the amount Underwood is going to pay in order to enter the partnership. Let's add in that $4,200, so we get $6,300. So Underwood is buying a 1/3 interest. So we need to determine what 1/3 of this new capital is. So let's divide this by 3. That's $2,100. So this is what he's buying. He wants a 1/3 interest. And this is what we credit to Underwood's capital account. Okay, but he's paying $4,200. And the situation says the bonus is shared by North and Ahern. The bonus is the difference between what he's paying and the accounting value. So our bonus is 4,200 minus 2,100, which is equal to 2,100. So this is our bonus. We split that between North and Ahern. So if we divide the 2,100 by 2, that's 1050. Okay, so the capital accounts of North and Ahern are each increased by 1050. Okay, so let's journalize this. Don't want to lose all my numbers here. I need some of those numbers. Okay, so we're recording this journal entry into the accounting records of the partnership. So we're going to debit the cash that Underwood is paying. Underwood's paying $4,200 in cash. Okay, so that's the easy part. Now we have to figure out what to do with everybody's capital account. So we have capital Underwood, capital North, and we have the capital account for Ahern. And all these need to be credited. Okay, so Underwood purchased a 1/3 interest that we determined was $2,100. So we're going to credit Underwood's account for $2,100. Okay, now North and Ahern, they get to split the bonus. So we determined that the bonus was $2,100. Okay, that's just coincidence. Okay, they're the same, but it's just coincidence. Okay, so North and Ahern split it 1050 each. Now our total debits equal total credits, and our journal entry is complete. Okay, now let's look at situation number 4. Situation 4. Underwood invested $690 for a 1/3 interest. Okay, $690, that's not much. The bonus is credited to Underwood's account. Remember the rules? If he pays less, then the bonus is credited to his account. So first step we do, we add this amount to the current capital balance. We had determined that the current capital balance was $2,100. I don't think I need to add that up again. If you can't remember where this comes from, just back up the video a little bit. So we're going to add the $690 to that to get a new balance of $2,790. So that's the total capital balance now with Underwood's investment. So since Underwood is paying for a 1/3 interest, we need to determine what 1/3 of this is, just like we did last time. We take $2,790 and divide it by 3. That's $930. Okay, so this is the credit to Underwood's account, but he's only paying $690. So the difference is 930 minus 690 is $240. Okay, so we split that between North and Ahern. So if we divide this by 2, we can do that in our head, $120 each. So the capital accounts of North and Ahern are each decreased by $120, which is a debit. Okay. So let's journalize this. First we have our debit to cash, $690. So that's the easy part. Okay. Now we need to reduce the capital accounts of North and Ahern. By by that amount of bonus that actually Underwood is getting. So we take it out of North's capital account with a debit. We take the other half out of Ahern's account with another debit. And then finally, we credit Underwood's capital account for 930. So this is what we mean by the partner that's being admitted is receiving the bonus because the value of this partner's capital account is more than what he's paying. Okay, so that wraps up Learning Unit 3. So what we've covered are just a few of the many different scenarios that could occur. So the key is to analyze the transaction and to determine who is giving money to whom and whether or not assets are being revalued. And I'm sure that you know from reading the course schedule and the syllabus, Learning Unit 4 is not assigned and I won't be covering it. And as always, please be sure to ask if you have any questions.